So we're midway through this shorter working week on both sides of the Atlantic. Of course, you had Memorial Day on Monday. We had another bank holiday as well, but plenty going on in the rest of the world. What have markets been up to today?
Yeah, so Johnny, it's a kind of a light economic calendar this week. Outside of, we do get preliminary GDP numbers tomorrow, which could be market impactful. I'll talk about that in a moment. You have PCE on Friday, but outside of that, it's been a relatively slow start to, as you mentioned, a shortened work week due to holidays in both countries. But I did want to kind of talk a little bit on what we're seeing play out today. You are seeing some interesting moves in the market. What you're seeing right now is the dollar index seems to have bottomed out, or at least for now, seems to be making a move higher towards the 105 mark again. And, the question is, what is that and why is that happening? Well, I think the answer, and where we should probably start our discussion today, is in the yields department. We see yields creeping higher here today. And remember, when government bond yields are rising, what that's telling you is that the bond market is demanding higher returns in exchange for the risk that they have to take to buy those bonds, right? That's the old concept of yields go up when bond prices go down, yields go down when bond prices go up. So demand for bonds wavering a little bit, and the idea there is because usually the economy is really strong and will cause inflation to continue, and or the economy is not necessarily strong, but inflation expectations remain persistent. And I think that right now we're seeing a little bit of a mix of the two scenarios, but the common theme is that inflation expectations are still remaining stubborn. And expectations specifically, who I'm referencing, is members of the Fed like Kashkari, which, the gentleman came out and has kind of made the point that the Fed is waiting for a series of inflationary numbers that are acceptable to them before they make any plans to drastically cut rates. And if you think about this, we are on today's date, the end of May here, coming in very close to the end of May. We're going into June. And remember, we started this year with the expectations from the Fed themselves, a dot plot of 3 rate cuts. And 3 rate cuts seems very out of the question right now. And now, as we continue to see that trend of rate cut expectations getting pushed back further and further, and then you have, Fed officials who are seemingly leaning hawkish again, despite, what has been a relatively dovish Jerome Powell compared to recent years, still some progress that needs to happen. And that progress that needs to happen is not something that markets want to hear, right? So we've enjoyed stock market rallies, and the dollar index has been coming off of its, highs, which has given way to other currencies performing well. I mean, if you have a look today, you have, the euro coming down a little bit with this recent dollar strength. You have the pound getting weaker because of the dollar strength. Dollar yen is kind of flat on the day, but the theme here, look at the Australian dollar down, 0.43% at the time of recording, and the New Zealand dollar against the dollar down 0.35%. The reason I walked through those right with you is because that the dollar index itself up 0.29% today, shows dollar strength is coming back into the picture off of hawkish tonalities from the Fed. Now, there was one other piece that was important to this, which was that they had a bond auction yesterday that didn't perform very well. Now, if you understand bond auctions, this is basically where people, bid on treasury bonds. And if treasury bond demand is very low, then yields have to go higher in order to entice buyers. That's the way of an auction works, right? If you're bidding for something and something isn't selling, the price has to come down. So the price of bonds came down, and hence the yields offered had to creep higher. So we're seeing this theme in combination with hawkish tonalities from the Fed and PMI data that has come out recently. It seems like, Johnny, there's a little bit of a pushback for dollar strength right now against the U.S.'s peers, specifically those in Europe and the Pacific. So seems to be a theme of hawkish tones coming back into the market and pushing back against this recent downtrend that we've seen in the dollar. That being said, the S&P 500, the NASDAQ are also off of their highs here with this. pushing back and where I think is really confirming when it comes to this story about whether or not the markets are moving mostly off of yields. I think what confirms that idea is that in the stock index world, you have the Russell 2000 performing the weakest of the major four, the Dow, Nas, S&P, and Russell. The Russell's performing the weakest because, of course, it is sensitive to rates and whether or not they get cut. If the rate cuts come, the Russell will likely perform very well, but today's downtrend in the Russell, down 1.10%, is signs of yields kind of putting pressure on the indices. If you enjoyed this video from the Market Insights Market Pulse podcast, you can listen to the full episode by clicking the link down below in the description. You can find us on your favorite podcasting apps, and again, we post several times a week, so if you're looking for market updates throughout the week, this is the place to be. Whether you're in the car on the way to work or something like that, make sure to tune in to get the latest. Thank you very much for watching. We'll see you on the next one.